I want to talk to you about something that I think is one of the most underappreciated skills in investing and honestly in life. It's not the ability to predict what happens. I've been wrong on timing more times than I care to admit. What I'm talking about is the ability to recognize what has to happen first before everything else breaks. Most people look at the stock market, the glowing green and red numbers on their screens, and they think that is the economy. They think that is the fundamental truth of our financial system. But they are looking at the caboose of the train and trying to figure out where the engine is headed. To truly understand the architecture of a financial collapse, you have to look beneath the surface into the dark plumbing of the global credit markets, where the real money moves, where the real risks are taken, and where the undeniable precursor to every major catastrophe first rears its head. Over my 50 years in this business, surviving and thriving through every major financial dislocation since the inflation spirals of the 1970s, I have learned that the system always gives you warning signs if you know exactly where to look. When I broke the Bank of England in 1992 with George Soros, it was not because we had a crystal ball. It was because we understood the mathematical impossibilities of the macroeconomic policies being forced upon the market. We saw the structural fractures before the mainstream narrative even acknowledged a problem existed. We recognized what had to happen first. Today, I am looking at a convergence of indicators that are flashing red so brightly it is almost blinding. Yet the mainstream media, the Federal Reserve, and the legions of retail investors buying the dip are entirely oblivious to the catastrophic storm that is gathering just over the horizon. They are operating on a fundamental misunderstanding of risk, driven by a recency bias that assumes because the system absorbed the last shock, it will naturally absorb the next one. But this time is different, not in the psychological sense, but in the purely mathematical sense of debt, leverage, and the insidious nature of the maturity wall that is about to hit the global economy. I need you to understand that the complacency we are witnessing right now is not a sign of strength. It is the ultimate indicator of profound recklessness, a reckless disregard for the fundamental laws of financial physics that will inevitably lead to a disorderly and painful unwinding of the greatest debt bubble in human history. Now, why am I telling you this today? Because I see the exact same patterns, the exact same willful ignorance, and the exact same structural fragilities that I saw in 2006, right before the entire global banking system nearly vaporized overnight. Back then, everyone told you that subprime mortgages were contained, that the sophisticated financial engineering of Wall Street had distributed risk so efficiently that a systemic collapse was virtually impossible. They were wrong then, and they are incredibly dangerously wrong now. The first and most critical warning sign, the infallible precursor to every market crash, is found in credit spreads, specifically the high-yield spread. For those who might not spend their days analyzing bond markets, the high-yield spread is simply the difference in yield between safe government treasury bonds and the risky corporate debt issued by companies with less than stellar balance sheets. In a healthy, rational market, investors demand a significant premium, a much higher yield, to compensate them for the risk of lending money to these highly leveraged corporations. But right now, we are seeing credit spreads compressed to historic, almost unimaginable lows. This means that investors are so desperate for yield, so utterly devoid of fear, that they are willing to lend money to the riskiest companies on earth for practically no extra compensation. It is a level of complacency that defies all historical logic. When credit spreads are this tight, it tells you that the market has priced in absolute perfection. It assumes that there will be no recession, no earnings compression, no liquidity shocks, and no defaults. But perfection is a myth in economics, and when reality inevitably falls short of perfection, these spreads will blow out with a violence that will rip through the equity markets like a hurricane. You have to monitor these spreads daily because they are the tripwire. The moment they start to widen, the moment investors start demanding actual compensation for risk, the countdown to the collapse begins. But tight credit spreads are just the symptom of the disease. The actual terminal illness infecting our financial system is the impending maturity wall and the accompanying coupon shock that is going to decimate the corporate landscape. We have spent the last 15 years living in an artificial fantasy world of 0% interest rates, a world engineered by central banks that allowed companies to borrow trillions of dollars for next to nothing. This era of free money created a phenomenon known as the zombie company. A zombie company is a business that does not generate enough operating profit to even cover the interest payments on its debt, let alone pay down the principal. In a normal free market capitalist system, these companies would go bankrupt, their assets would be liquidated, and capital would be reallocated to more productive uses. But because debt was essentially free, these zombies were allowed to roam the economic landscape, continuously rolling over their massive debt loads at progressively lower interest rates, staying alive on a steady drip of central bank liquidity. They engaged in massive leverage buyouts, repurchased their own stock to artificially inflate earnings per share, and compensated their executives wildly, all while building a mountain of debt that they could never realistically repay. But the era of free money is definitively over, and the consequences of that shift are about to manifest in a truly horrifying way. As we move into 2025 and 2026, a staggering portion of this corporate debt, trillions upon trillions of dollars, is coming due. This is the maturity wall. These zombie companies and even otherwise healthy companies that gorged on cheap debt cannot simply pay off this principal. They must refinance it. But they will not be refinancing at the 2 or 3% interest rates of the past decade. They will be facing a brutal, unforgiving market where they must refinance at 7, 8, or even 9%. This is the coupon shock. It is a mathematical certainty that a massive percentage of these companies will not be able to absorb this exponential increase in their debt servicing costs. Their profit margins will be completely crushed. Their free cash flow will turn deeply negative, and they will be forced into desperate measures. They will halt all capital expenditures. They will liquidate assets at fire sale prices, and most importantly, they will begin massive, widespread layoffs. This is not a hypothetical scenario. It is a mathematical inevitability written into the very contracts of the bonds they issued. The math simply does not work, and when the math breaks, the companies break, and when the companies break, the defaults begin. And defaults are never isolated events. They are the genesis of credit contagion. But the danger does not stop at our borders. We live in a deeply interconnected global financial system, and to understand the risk to the United States, you must investigate what is happening across the Pacific, specifically with the Bank of Japan. For decades, Japan has been the anchor of global monetary policy, maintaining negative interest rates and artificially suppressing their bond yields through aggressive yield curve control. This created the massive yen carry trade, where investors would borrow yen for practically nothing and use that cheap capital to buy higher-yielding assets around the world, most notably United States Treasury bonds. The Japanese became the largest foreign holders of U.S. debt, effectively financing our massive government deficits. But the Bank of Japan has finally been backed into a corner. Inflation is rising in Japan. Their currency has been rapidly depreciating, and they are being forced, kicking and screaming, to abandon their zero interest rate policy. They are beginning to raise rates and allow their bond yields to rise. This seemingly distant policy shift is a catastrophic threat to the U.S. domestic reality. As Japanese yields become more attractive and as the cost of borrowing yen increases, the math of the carry trade completely inverts. Trillions of dollars of Japanese capital that was parked in U.S. treasuries will be repatriated back to Japan. They will become forced sellers of U.S. debt at the exact moment when the United States government is issuing record amounts of new debt to fund its multi-trillion-dollar deficits. This massive supply of bonds hitting the market, combined with the sudden disappearance of the largest marginal buyer, will cause a severe dislocation in the Treasury market. Bond prices will plummet and yields will skyrocket, completely outside the control of the Federal Reserve. This is how a sovereign debt crisis begins, not with a dramatic default, but with a sudden, uncontrollable spike in borrowing costs driven by foreign capital flight. This brings us to the concept of the term premium, another critical technical metric that almost no one on financial television understands or discusses. The term premium is the extra compensation that investors demand for the risk of holding a long-term bond compared to rolling over short-term bills. For years, the term premium has been negative, reflecting the market's misguided belief that inflation was dead and that central banks had permanently conquered the business cycle. But as the sheer volume of government debt explodes and as foreign buyers like the Japanese retreat, the market is waking up to the reality of inflation and fiscal dominance. The term premium is violently turning positive, pushing long-term interest rates structurally higher. This is the invisible hand of the bond market reasserting its dominance over the central planners. And it is a terrifying prospect for an economy that is addicted to cheap long-term leverage. When you combine this rising term premium with the maturity wall, the coupon shock, and the widening of credit spreads, you create an environment where a crash is not just possible, it is mathematically mandated. To synthesize all of this, you must watch for the convergence of the three death knells of the global economy: rising interest rates, a rising US dollar, and rising oil prices. Historically, whenever these three forces spike simultaneously, it breaks the back of the global financial system. Rising rates crush asset valuations and choke off credit to the real economy. A rising dollar exports inflation to the rest of the world, devastating emerging markets that borrow in dollars and forcing foreign central banks to liquidate their U.S. Treasury holdings to defend their own currencies, which ironically pushes U.S. rates even higher in a vicious doom loop. And rising oil prices act as a massive regressive tax on consumers and corporations alike, destroying discretionary spending and crushing profit margins at the worst possible time. Right now, all three of these death knells are converging. The structural forces driving inflation, from deglobalization to the massive costs of the green energy transition, guarantee that interest rates will remain elevated far longer than the market expects. The geopolitical instability and the massive structural deficits of the U.S. government ensure that the dollar will remain weaponized and volatile. And the chronic underinvestment in fossil fuel infrastructure guarantees that energy prices will remain highly susceptible to supply shocks. The mainstream narrative will tell you not to worry. They will point to strong consumer spending or a resilient labor market, but they are looking in the rearview mirror. They do not understand the logical sequence of a collapse. It never happens all at once. It is a slow, insidious process that suddenly goes exponential. First, you see the credit stress and the plumbing of the financial system, the widening of the high-yield spread, and the failure of zombie companies to secure funding. Second, as banks and private credit markets take losses on these defaults, lending tightens dramatically across the entire economy. Small and medium-sized businesses, the true engine of employment, suddenly find their credit lines slashed or revoked entirely. Third, this sudden lack of capital leads directly to lower economic activity, halted expansion plans, and a massive wave of cost-cutting. Fourth, this cost-cutting inevitably translates into higher unemployment, as the layoffs that began in the zombie sector metastasize into the broader economy. And finally, only after all of this has happened, only after the damage is irreversible, do you see the massive equity repricing. The stock market is always the last to know. It will remain elevated, driven by speculative mania and the passive flows of index funds, until the reality of cratering corporate earnings and surging unemployment shatters the illusion. And when the panic finally sets in, when the retail investors realize they have been left holding the bag, the sell-off will be merciless. What makes this impending dislocation so uniquely dangerous, so much worse than 2008 or 2020, is that this time the United States government has absolutely no financial buffer left to save the market. In the past, when the system broke, the government could borrow trillions of dollars to bail out the banks, send checks to citizens, and stimulate the economy. The Federal Reserve could slash interest rates to zero and print trillions of dollars to monetize that debt. But today, the national debt is already over $34 trillion. The deficit is running at $2 trillion a year during an economic expansion, and inflation remains a persistent, sticky threat. If the government tries to borrow another $5 or $10 trillion to fund a bailout during the next crash, the bond market will simply refuse to absorb it without demanding massively higher yields. The vigilantes are back. If the Federal Reserve tries to print that money, they will instantly trigger a hyperinflationary spiral that will destroy the purchasing power of the currency and collapse the very foundation of the U.S. economy. They are trapped. They have spent all their ammunition fighting the last war, and now they are facing a catastrophic multi-front conflict with an empty magazine. This is the reality of the $306 trillion global debt burden. It is a mathematical trap from which there is no painless escape. The system must clear, the malinvestment must be wiped out, the zombies must be allowed to die. It will be a disorderly, painful, and terrifying process for those who are unprepared, for those who blindly trusted the infallible facade of the central banks and the mainstream media. But for those who recognize what is happening, for those who understand the mechanics of this collapse and respect the logical sequence of events, it will be the greatest wealth transfer in generations. So what do you actually do with all of this information? How do you survive and ultimately thrive in an environment that is mathematically programmed to destroy wealth? The most important thing you can do right now is to preserve capital. Do not be a hero. Do not try to catch falling knives. Do not let the fear of missing out drag you into the final desperate blow-off top of a dying bull market. You must ruthlessly evaluate your portfolio and eliminate any exposure to companies that require cheap debt to survive. You must recognize that the traditional 60-40 portfolio of stocks and bonds is fundamentally broken in an environment of fiscal dominance and rising term premiums. You cannot afford to take asymmetric bets against yourself by locking up your capital in illiquid, highly leveraged investments that will be crushed under the weight of the maturity wall. You need to be in the safest, most liquid instruments available, positioning yourself to be a buyer of distressed assets when the panic reaches its zenith. Monitor the credit spreads daily. Watch the actions of the Bank of Japan and the movements in the Treasury market. Investigate the balance sheets of the companies you own to ensure they can survive the coupon shock. You must have the discipline to absorb the psychological pain of watching others seemingly make money on paper while you sit in cash or short-term equivalents, knowing that their gains are illusory and will be wiped out in the blink of an eye when the contagion spreads. Be patient. The unwinding of a 50-year debt supercycle takes time, but when the dam finally breaks, the devastation will be absolute. You must pay very close attention to these undeniable precursors and make sure you have the capital to take advantage of the opportunities that will absolutely exist on the other side of this collapse. Preserve your wealth, stay extremely vigilant, trust the math over the narrative, and prepare yourself for the inevitable reality that almost no one else notices until it is far too late.